Hello, I'm Steve Dubb. My pronouns are he and him, and I'm Strategic Initiatives Editor here at Shelterforce, coming to you from Boston on land historically stewarded by the Massachusetts Nation. Over the past years, I've participated in many joint webinars with Shelterforce, but this is my first time moderating for Shelterforce. I am pleased to have joined the Shelterforce team, and we look forward at Shelterforce to hosting many additional webinar conversations this year. For this webinar, Making Home Ownership Affordable, Bringing Fannie and Freddie Back to Mission, Shelterforce is pleased to partner with the Lincoln Institute of Land Policy, which just last month published a 16-minute video on how the government-sponsored enterprises, Fannie Mae and Freddie Mac, were created to support housing affordability, but need to adjust their strategies to meet their mission of promoting affordable homeownership today. This webinar aims to expand on and deepen the discussion of how this can occur. For our webinar, we are joined by three expert panelists. George McCarthy is President and CEO of the Lincoln Institute of Land Policy. Sarah Morgan is President of FAHI, an Appalachian-based community development financial institution. And Tony Pickett is CEO of Grounded Solutions Network, a national group that supports community land trusts, deed-restricted housing, and inclusionary housing. A few notes. First, please feel encouraged to introduce yourself in the chat, as well as to pose questions for the panelists. We will leave the last 20 minutes or so of this webinar for your questions. Second, we will share the recording within a week or two after the webinar, so please don't ask, will I get the recording? You will. Thanks for joining that. And with that, I want to begin with Mac, and can you introduce yourself briefly, talk about the Lincoln Institute for Land Policy, and talk about why Fannie and Freddie exist and why these institutions are so important in our housing system.
Sure. Thanks, Steve, and thank everybody for joining us. This is a topic near and dear to my heart. Hopefully, it'll be near and dear to yours by the time we're through. So, yeah, the Lincoln Institute of Land Policy, we're an 80-year-old think tank working on finding ways to use land policy, land-based financing, any ways that land can be deployed to address larger social, environmental, and economic challenges. Fannie Mae and Freddie Mac, or otherwise known as the GSEs. So the way I see it, they were created to fix structural failures in the housing finance system. So in order to understand that, you have to kind of go back to their origins. And their origins come from the Great Depression. During the Great Depression, in the 1932, the banks collapsed. And one of the reasons the banks collapsed was because they were holding mortgages on properties that were all kind of bought or refinanced during the 1920s. But in the 1920s, the typical mortgage was a 50% loan-to-value ratio, interest-only note with a 5-year duration. And what that meant was that people would, put half of the money down, buy their home, and then they would pay interest on the note. And after 5 years, the bank would ask them either to pay off the balance or they would refinance them. Typically, they would refinance them. But when money was short and people started to lose jobs, they also lost their ability to pay their mortgages. And they certainly didn't have enough money at the end of a 5-year period to buy their home. And the banks were running out of liquidity because people were defaulting on mortgages and they didn't even have enough money to cover their deposits. So the banks weren't willing to refinance, and so they were offering people the opportunity to either buy their home or lose it in foreclosure. And as you already know, millions of people lost their homes in foreclosure during the Great Depression. The way forward, certainly with FDR, was the New Deal, and the New Deal was just a kind of a way to kind of keep the country together and to keep it together kind of in a centrist fashion. And the primary way they did it was by really extending homeownership to as many people as possible by creating the housing finance system. And that was based primarily on a new invention in the 1930s, the 25-year self-amortizing mortgage. And this was created by a thing called the Homeowner Loan Corporation, which was also a way of helping people to avoid foreclosure on their loans. But banks were kind of reluctant to be lending out at 25 years at a time, especially after they'd been pushed to the brink of bankruptcy themselves by their housing finance system or by the mortgages they were holding. So the federal government decided they needed to do something else, and they created the Federal Housing Administration as a way to assure banks that if they're willing to lend long, 25 years, that the federal government would stand behind the borrowers. And in the event that the borrowers couldn't pay their mortgages, the federal government would jump in and pay their mortgages on their behalf. So this is the first kind of financial guarantee that we'd seen established in the housing finance system anywhere in the world. So banks said, sure, we'll lend long if the FHA will guarantee it. And so they started lending to people to refinance their old mortgages or buy new homes. And they did it so well that they ended up running out of money. So all the banks were sitting on all these mortgages, these 25-year mortgages on their balance sheet. They didn't have any more money to lend, and they needed a solution. So the federal government, once again, kind of came to the rescue by creating a secondary mortgage market in the form of Fannie Mae Corporation. And so the way that worked was Fannie Mae would buy the mortgages off of the balance sheets of the banks, and they would issue their own debt in the form of bonds, and then they would pay off the bonds with the proceeds from the mortgages when people paid their mortgages back. And the money that they used to buy the mortgages from the banks went back onto the balance sheets of the banks so they could lend again and lend to new people to buy mortgages. And this was phenomenally successful. It created a multi-trillion-dollar housing finance system in the United States, and it helped about 2/3 of American families become homeowners by the 1960s. But the other thing was that even with their ability to issue debt, issue bonds, and buy mortgages, and then pay off borrowers, the idea was that there still wasn't enough money available for Fannie Mae and Freddie Mac to kind of continue to fuel this housing finance needs of the country. So in 1969, Fannie Mae was given permission to securitize. And securities were created where Fannie Mae would buy mortgages off of the balance sheets of banks, but instead of issuing their own bonds, they would bundle them into mortgage-backed securities and then sell the securities themselves to investors around the world. And so basically what this did was it opened up the housing finance system to global capital markets. But the federal government didn't want to give Fannie Mae monopoly power in that realm. And so they created Freddie Mac basically as competition, well, at least the illusion of competition. So they now had two entities that could do exactly the same thing, which was to buy mortgages off of the balance sheets of banks, bundle them into mortgage-backed securities, sell them to global investors, and that just really, really kind of ginned up the housing finance system long term. So anyway, for at least their first 40 years, it seemed like the GSE's main goal in the world was to provide liquidity for the housing finance system. And that was true, but it was also true that they did other things. They created very efficient executions in the mortgage system. They really found a way to kind of professionalize and build up housing mortgage originators who would then originate the mortgages and sell them to Fannie and Freddie. And they created a system that was the rival of the world, frankly. But it wasn't just liquidity, and it wasn't just kind of efficiencies, because the federal government also decided that Fannie and Freddie, because of the privileged position they had access to low-cost debt. They were the only two entities allowed to securitize this debt into the global markets. That they really owed the taxpayer something else. And what they owed the taxpayer was the kind of the commitment to solve other structural problems in the housing finance system, primarily reaching reaching people that otherwise wouldn't be reached by the housing finance system, providing products that otherwise wouldn't exist until they were invented by Fannie and Freddie, and later really being able to establish housing finance in new markets through what they call duty to serve. So there were goals and mandates that were layered onto Fannie and Freddie by the federal government called affordable housing goals, duty to serve goals, and they're asked to serve markets like manufactured housing, rural markets, and low and moderate income borrowers, as well as even multifamily markets. But all in all, Fannie Mae and Freddie Mac, the GSEs, were created to be problem solvers. And so that's what they did really, really successfully through basically through the great financial crisis when, things went bad and the federal government had to take them over in conservatorship. But since then, they've actually kind of lost their mojo, and they are not problem solvers in that same way. And hopefully, with our help and the help of others, we'll persuade Fannie and Freddie to become the problem solvers that we know they can be, and they have historically been. So thanks, Steve. Hopefully that was a good long answer to a short question.
Sarah, can you introduce yourself briefly and talk a little bit about FAHI and how the operations of Fannie Mae and Freddie Mac support housing affordability today and where they fall short from your perspective?
As a CDFI, we reach a part of the market that the traditional market doesn't meet. We're working with low-income borrowers, and we're working in low-income communities. Being able to be credentialed with a Fannie or Freddie seller servicer status means people can understand us differently than sort of the niche CDFI world. So that was huge. Unfortunately, in rural America in particular, there's less liquidity, period. So whether that's at an individual home buyer's individual balance sheet or at a community level. And so where I think Fannie and Freddie both do a terrific job is if you've got good credit and you've got liquidity, you have your own personal liquidity, they can make those loans all day long. Where it's harder is when you're in places where folks are lower income, like Appalachia, where we have many communities that are persistently poor, and folks don't have 6 months of cash in the bank, and they have multiple risk factors. Fannie and Freddie struggle there a little bit, and I think we could help them learn to do more.
Thanks, Sarah. Tony, could you introduce yourself briefly and talk about from your perspective, and Ground Solutions perspective, where Fannie and Freddie are supporting affordability today and where they're falling short?
Sure, Steve, thanks. Yes, I'm the CEO of the Grounded Solutions Network, and we are a national network of just around 300 members. And Steve, as you alluded to earlier, we support a variety of nonprofits and municipal governments who are all focused on expanding affordable homeownership using a very unique approach called shared equity homeownership, really providing affordable homeownership, but keeping the same home affordable upon resale. There are resale restrictions that go along with shared equity homes, and those homes are also stewarded by nonprofit programs who really have the best interests of the family who's buying that shared equity home, making sure that they're successful in maintaining homeownership. We've worked with Fannie and Freddie in the underserved mortgage markets work. They consider shared equity one of those markets that Sarah mentioned earlier. And we've really focused with them around figuring out ways to increase the volume of shared equity mortgage lending. Our members over the years have reported to us one of their biggest challenges is accessing shared equity mortgage lending. Individual lenders, because as we said earlier, and as was said in the video for this webinar, because they're not familiar with it, they resist lending, making those types of loans. So we want to open up that lending channel in partnership with both of the GSEs. Over the years, that has focused on different things, but I'll just talk about three primary things that has resulted from really our partnership with the GSEs. One is we have standardized shared equity ground leases. One of the methods that is used frequently to create shared equity homeownership is a community land trust. That's probably the most familiar model to folks. And it employs typically a ground lease, although it can use a deed covenant as well. But the ground lease really needs to be based on our template in order for the GSEs to really offer to purchase the loans that are made using those ground leases. We also have created a model deed covenant to cover those instances when the ground leases aren't used as well, that both GSEs recognize today. Also, shared equity program certification, really certifying that programs actually have the basic capacity to operate a shared equity program. So certifying that those nonprofits can actually successfully run the programs. And that's designed to ease the underwriting burden for lenders who want to make those shared equity mortgage loans. And then thirdly, we partnered several years ago with Freddie Mac and modeled what was called then a single family rental portfolio to shared equity transition. And we really looked at if we were to acquire portfolios of single family homes just opportunistically that are offered up by, say, private equity interests and operate those as rental properties for some period of time, allow equity to build up in those homes, and use that equity as the subsidy to convert them to affordable home ownership, that would open up a larger pipeline of shared equity home ownership opportunities. We've been successful in not only modeling that, we created a new internal department at Grounded Solutions called our Innovative Finance Team, and we launched an initiative called Homes for the Future, and we purchased a 280 home portfolio in the Minneapolis-St. Paul area that is today being operated by a third-party manager that reports to us and several other investors. We raised low-cost capital in order to be able to buy that portfolio. And I'll talk a little bit more about some of the future possibilities of that because we want to replicate that in other markets.
Fantastic. Thanks, Tony. So this is a question for all of you, and you can jump in however you want. But one of the issues that gets talked about in terms of housing finance certainly is the role of risk assessment. You know, when Fannie and Freddie are underwriting loans and buying the loans as securities, what are they getting right and wrong about their assessments of risk?
Steve, I'll jump in first because I will just say I have an emotional reaction to the term risk assessment, especially when it's associated with our work around shared equity homeownership. Mac knows this really well because in partnership with the Lincoln Institute, we published 30 years of shared equity performance data that virtually says there is no risk. We've mitigated the risk that is associated with shared equity affordable homeownership. During the height of the subprime mortgage crisis, there was virtually no foreclosure related to shared equity homes. The market rate of foreclosure during that time period was 10 times what it was for shared equity homeownership. And shared equity, that rate was 0.006%. So why are we having this conversation continually about risk? And the way the program is designed, that stewardship function of the shared equity program, it gives most of them the right to step in case of homeowner default. So we've lessened the risk as much as we can in relation to that. So I think we really need to kind of do a reset around this conversation of risk. It's less about the actual uh, data and documentable risk. Again, they're not familiar with it. It is really what the issue is. And there's some gatekeeping going on because of that lack of familiarity.
Yeah, I'll jump in there, Tony, because one of the things about Fannie Mae and Freddie Mac and the way they chose to manage risk was to well, number one, drive efficiencies into the market by characterizing what they consider to be the lowest risk kind of product, what we call the vanilla mortgage, right? And so everything that fits into that box, they consider to be low enough risk to be for them to be willing to buy. And unfortunately, when they set that standard became kind of an industry-wide standard for every product. And any other product that falls outside that box is something that for a long time they wouldn't even consider. Until, of course, they started to lose market share and they got into it at the wrong time during the great financial crisis. But so when they underwrite loans, they underwrite loans based, of course, on collateral, credit, right? But they don't use character anymore because they don't have no way of assessing the character of the borrower. And so the old ways the banks loaned on the three C's, collateral, credit, and character. Fannie and Freddie kind of narrowed down to just collateral and credit. And they systematically kind of overestimate the risk associated with either of them. So I'll give you an example, right? So in terms of collateral risk, one of the things that Fannie and Freddie will only do is buy a mortgage that's either got an 80% loan to value ratio or it is privately insured, and they will definitely not buy anything that is under collateralized, meaning where the value of the house is less than the actual value of the debt. Now that's predicated on this whole idea that when people are underwater, they're going to instantly default. And that's something that was never, ever proven, even during the worst of the great financial crisis, where the vast majority, we're talking about 8 or 9 out of 10 people who are underwater in their mortgages continue to pay their mortgages on time. And one of the things they always get wrong about the collateral thing is that people don't even know what their house is worth. They only know whether they can afford to live in the house they're living in, and then they have to make decisions if they can't afford to live in it. So they get that wrong, right? On the character side, one of the things they systematically get wrong about the low-income borrowers is they underestimate they overestimate the prepayment risk. Now, risk for Fannie and Freddie Mac is that when the money stops flowing for any particular loan, then they have to make good on those loans to their investors. The worst thing that happens is, of course, someone defaults and they stop paying their mortgage. But the other thing that happens is people refinance or they sell their house or they prepay, and Fannie and Freddie have to take that mortgage back and then settle that through the security chain. That is, well, let's just say it's a pain in the butt, right? So what they failed to recognize for the longest time, and they still don't really price it right, is that low-income borrowers prepay at a tiny fraction of the rate that higher income borrowers do, because when a mortgage is in the money, meaning that they could refinance for a lower rate, a lot of low income borrowers can't qualify, and so they don't even bother to go down that path, right? So and then finally, I just give you one more because I have a whole long list. They fail to take into account other things that have bearing on the repayment of the mortgage. They don't price in energy efficiency, for example. And one of the things we found through lots and lots of examples, people who buy houses that are energy efficient are much better credit risk because they don't have high energy bills, and so they have more kind of residual income that's available to pay their mortgages. Fannie and Freddie refused to actually kind of price that in, even though we tried over years to get them to introduce special products to promote energy efficiency of houses. And Steve, I have more examples, but I'll let Sarah jump in because I know she has others, right?
All right.
Thanks, George. So when the Great Recession hit in 2008-9, we at FAHI looked at our delinquency rate, and during that entire period, when the foreclosures were going through the roof, our 30-day delinquency rate stayed under 5%. And we've got an entire portfolio of, this is before we started selling to Fannie and Freddie, we had an entire portfolio of loans that were made to low-income people in a very low-income part of the country. What we do that's different is we will deal with multiple risk factors that Fannie and Freddie don't like to do, but we also provide housing counseling to those families so that they know what they're getting into. They know what's going to make them successful along the way. And then we make sure we don't max out their debt load. So where most lenders will try to target 30% of the income for what they would lend to somebody for their payment, for low-income people, we were targeting closer to 20% because we wanted them to be successful. And that's a place I think community development financial institutions like FAHI and others across the country, what we do is small in comparison to what the total lending that Fannie and Freddie, total purchase that Fannie and Freddie do. And I've said this before, if they would invest the couch cushion money in pilots, we could start to demonstrate how successful this kind of lending can be.
So I would say, Sarah, that what that is really, I mean, just to put a bow on it, Fannie and Freddie refuse to look at credit enhancement in any way. And the kind of credit enhancement you're providing is a prepared borrower, better terms, and they won't price to that. And when you ask them to price to it, what they do is they say, we don't have enough data, right?
That's right.
And getting enough data would require what? Oh, well, maybe they create a product and they study it over time and say, oh, hey, look, this works, right? But they just wouldn't do it. And we gave them a lot of data when we did the community assistance program with Self-Help Credit Union when I was at Ford, where we helped to finance like 50,000 borrowers with non-conforming loans who had good products, who were prepared, and who had some good kind of workouts arranged through self-help if they did end up going into default. And lo and behold, those loans performed better than almost anything in Fannie's book during the financial crisis.
That's exactly how we got started, was watching what Ford did with Self-Help Credit Union, and then access to resources like the Home Investment Partnership Program, the CDFI Fund, and others allowed FAHI to step into that kind of lending. Unfortunately, when you're working off of what I call soft money or subsidy, we were able to in the early days, meet each borrower where they were at, which means we don't have a bunch of data of loans that look and smell the same. We've been building that in the last 10 years. They were willing, like Fannie and Freddie both were willing to look at the data. We just didn't have a consistent product to show.
Yeah, great, thanks. So I think we've established that there are some shortfalls in risk assessment, to put it mildly. Where are there opportunities to expand housing access? What could Fannie and Freddie do differently? And how are those barriers overcome? Because clearly something is holding them back from looking at the data that you cited and so forth. So there must be interventions that are required to move those institutions. So anyone want to jump into that?
Well, I agree with the idea that there needs to be some increased level of investment. I don't know if I'd quite phrase it as pilot, because they tend to think small when you use that term. But I've been looking along with some partners for a while at their social impact bond capacity and wondering what criteria are they using. They say they want to support expansion of the underserved markets, but wouldn't social impact bond use be a great fit for starting to do that, and would open up a larger channel of financial support for a range of the uses that we're talking about. Sarah's work, my work, Rock USA, others could really tap into that. And I think the question is, what does it take in order to get that kind of conversation going? Let's be proactive about it. I feel like we've been in a reactive mode. They sort of suggest what they'll do in terms of their um, finance plans, and we react to that. But could we maybe change some of the dynamic of the conversation and identify, you already do this, so can you do it in support of expanding access for underserved markets?
So, Steve, one of the most egregious ways that Fannie and Freddie behave in the market is their willingness to underserve the multifamily manufactured housing space. And specifically, and Tony mentioned Rock USA, Fannie and Freddie have provided billions of dollars of capital to private equity and REITs to buy up manufactured housing communities over the course of mostly since about 2015. And they systematically buy the parks, reduce services, increase rents, and they displace a lot of people who can no longer afford to stay in their own home in a manufactured housing community because they can't afford the lot rent. Now, during that whole time when they provided billions of dollars to private investors, they only provided financing to one or two resident-owned communities. And the reason they did that was because they could meet their underwriting guidelines. And this gets back to their assessment of risk. They're saying that it's too risky to invest in co-ops who are going to buy manufactured housing communities. And yet Rock USA has 357 manufactured housing communities that have been bought by cooperatives with zero defaults. They have never lost money in that game. So why is it that there's zero defaults with 357 examples isn't enough data for them to be able to access the same financing that a private equity or REIT would have to go buy up all these manufactured housing communities? It's a mystery to me, especially given that the duty to serve requirements require that they actually serve the manufactured housing space, right?
And Mac, I think the same dynamic has gone on the private equity single family acquisition side as well. They've been supporting that acquisition effort to the detriment of those of us who are more mission focused.
Yeah. And sorry, but here's another one. So they'll never make a loan to any home that has an appraisal gap. And we know where appraisal gaps end up being in all these really difficult markets where it costs more to acquire, rehab, and sell a home than you can get a mortgage for because it won't appraise, right? But that's because they're only going to be willing to use comp appraisals, right? And the reason that now the investors are going to come in and buy those homes is because if you use the cash flow appraisal method, you capitalize the cash flow, those homes pencil out. So they can land on a home that someone's going to buy to invest in and rent rather than giving somebody a mortgage to buy it themselves. It's absurd, and nobody has been able to solve this appraisal gap problem, except of course the investors who say, "Sure, I'll buy those homes," right? Yeah.
Sarah, did you want to jump in on that, or are you?
Just
I guess, and also where's the opportunity for positive change? Because we acknowledge that there's a strong case. How can this be? How can Fannie and Freddie be moved?
Well, and I think they're trying, is what I would say, to some degree. We're working on high ground communities in Kentucky in response to the natural disaster that happened in 2022 in Eastern Kentucky. And we've gotten a waiver from, I believe, Fannie Mae to allow soft debt from a nonprofit developer to be behind a Fannie Mae first, and which is necessary when you're moving millions of dollars of block grant dollars to help people get back into a home, but that still has to be secured in the home for affordability periods. So they're I think attempting to try. I don't think I'll ever be satisfied that it's far enough, because we've got a lot of people we have a housing crisis in our country. And with the interest rates that had been so low for so long, and now they've gone up, we've got a lot of people who are not moving out of their homes when their children leave to downsize. So that's even constricting the market even more. And that was before we're in 2020, I think we're building 10% of the entry level homes that we were building after the World War II. So there's more that can be done on the construction to perm side. I think Tom Collishaw made a comment in the chat. I think they're trying to get there, but I just don't think it's, we'll see how those products really move on the market.
So, Sarah, you don't want to blow your own horn, but it's really important to point out that Fannie and Freddie are not primary players in the market. They're a secondary market, and they rely on other people to originate loans. And they've relied for the longest time on banks, and now they rely on non-banks like Rocket Mortgage. But what they haven't done is thought about the kinds of originators like Fahi, like others, like CDFIs, like Come Dream, Come Build, that are able to actually reach new markets that they wouldn't otherwise be able to reach. But at least to my knowledge, you are the only two CDFIs that are seller servicers to Fannie Mae. And very often you guys also bundle mortgages for other people to go sell to Fannie Mae. But why doesn't Fannie Mae open up new origination channels, like creating a special product for CDFIs that would incentivize more and more CDFIs to get into the direct mortgaging business, right? Nobody wants to make small mortgages. You guys make small mortgages, right?
Yeah, they make products available for the HFAs, special products for the housing finance agencies like Kentucky Housing Corporation and my Commonwealth. And we are in discussions with them both about a specific CDFI product. There are a handful of other CDFIs that are seller services. I think Hope Credit Union might be one, and there's one in Chicago. So there's just a handful of us. But yes, and it's a big lift.
And then Tony, you're Fannie and Freddie have had special CLT products on their books since the 1990s, right?
Right.
And you can probably count on a couple of hands the number that they've ever done, right? And whenever you're asking why haven't you done more business in community land trust, they say, well, no one's originating them, right? But why would no one originate? Because they're small loans, right? And why can't we get CDFIs into the space to originate CLT loans and then sell them to Fannie and Freddie and get decent terms?
Yeah, you're correct, Mac. And we are finding more and more CDFIs who are interested in expanding into the space. Both the National Housing Trust as well as the National Cooperative Bank are now working with us to expand their footprint in the area. But I think there's also traditional lenders who are now saying they have CLT mortgage product. They just need more help in getting connected to the pipeline of opportunities, which we're putting ourselves in that position to be able to help that happen. But I still would say, I feel like from the GSE standpoint, they view all this as an exploration, an exotic exploration, rather than a core business function, which I think we need to kind of have a conversation to say, well, given the fact that there's a limited opportunity for first-time home buyers to be able to afford to enter into homeownership, and in our case, again, back to the data that we've collected with your help, the majority of the buyers are first-time home buyers, and the average tenure that they stay in those shared equity homes is 5 to 7 years before 60% of them go on to purchase a market rate home. So why wouldn't you invest in creating that kind of opening in access to home ownership that can serve more than one family over time, and see that as a core part of the business?
It's a mystery.
I would also add, before the Great Recession, we had an investment from Fannie Mae at Fahi alone that helped us spur the construction of more entry-level homes. During the Great Recession, they sort of like, nope, you got to pay that back. We're not allowed to actually make loans. We only buy loans. They could take part of their profits and reinvest in the system to create more entry-level homes. which is one way they could invest. And they're allowed to make equity investments into rental housing. Why not make equity investments into CDFIs to let us serve the part of the market that they don't want to serve?
Thanks. So I think I want to start going to some of the audience questions, and then I'll give you a chance at the end to like wrap up a little bit as well. But one of the questions was about the role of FHFA in all of this, and what is the role of also of state and county finance agencies in making housing more affordable? How can they interact with the GSEs?
Well, I'll talk about the FHFA because, every major lender is regulated by somebody, and Fannie Mae and Freddie Mac are regulated by the Federal Housing Finance Agency. Unfortunately, that's a highly politicized regulator. It's probably the most politicized regulator in my view. And so whomever is in the position to be running that can kind of set the tone on, or can really kind of abridge what Fannie and Freddie can do in the marketplace by deciding when something's too risky, or giving them permission to kind of open up their portfolios for new kinds of products, and even giving them the green light to do whatever experiments or pilots, I don't know what you want to call them, Tony, but to actually, break trail into new markets, right? And so because of that, there's a long duration when you have somebody in that seat at FHFA who wants to really, really constrict the role of Fannie and Freddie in the market. Even after they leave, it takes a while for the market to recover, because remember, Fannie and Freddie don't operate directly in the market. They wait for other people to originate products that they will buy, right? So that's a key problem. And in my view, the FHFA is not as accountable as it needs to be to the rest of the field. When they make their decisions, it's pretty much fiat. They don't really have to do very much. I mean, they might, they send out the duty to serve plans and stuff for public comment and all that, but really, until we formed the Underserved Mortgage Markets Coalition, it was a Tower of Babel, right? They would collect the duty to serve plans, they put them out there, and 900 people comment in different ways. And until we were able to kind of coalesce around like a few key issues that everybody in the field really cared about, nothing would happen, right? And that was fine with FHFA because they didn't really want to exert that much influence on Fannie and Freddie, except to make sure that they were staying within their bounds and bringing lots of money into the national treasury, right? So it's tricky. It would be great if we had an FHFA that was really wanting to push them into new markets and figuring out how to explore new markets without really sacrificing safety and soundness. But that hasn't happened in a long, long time, or almost never happened.
Got it. Thanks. Let's see. There was a question about so this is a question about market conditions. So obviously, if there were, it says, what would be the effect on Fannie and Freddie if the market suffers, from, international conflict? Not that that would be possible, but or energy interruptions and possible, possible recessionary type developments. How obviously that's going to negatively impact construction rates. How can I guess Fannie and Freddie be effective, in those kind of situations, or can they be?
All right, I'll just jump in with one.
There was a great recession back after the, so we've had some history with this.
Yeah, so I mean, the thing is, so the key to players like Fannie and Freddie in the market is they have a huge role if perceived risk is higher than real risk, right? Because they can fill in that gap and they can generate enough economic activity to really establish whether the perceived risk is real, right? But they're not dabbling in that space as much as they could, and they've been really discouraged from dabbling in that space a lot by the FHFA, which everything we've been talking about would fall into those categories where they would be willing to extend products. They would change the nature of the mortgages. They would price right, for lower risk mortgages, high, energy efficient mortgages, all these other kinds of things. So there's a lot of role they could play, but all of it is, once again, them signaling to the market their willingness to buy a product that has those characteristics. So it's a little bit tricky, and they have to rely on the fact that it's like a field of dreams. If you create the product, people will come to it by, originating them. And that doesn't always happen, because I think there's probably a longer list of products that Fannie and Freddie have created than that have never been originated than the ones that actually work, right? I've seen dozens of them. So I don't know. I don't know if that's a good answer, but that's my answer.
Well, I appreciate it. Thanks. Let's see. Another audience question. One of the participants here, says it seems to them that the challenges with Fannie and Freddie that are being described are fundamentally structural. How they codify market rationality needs to change, and perhaps this is a need for an area of advocacy. So I want to throw this to Tony and Sarah and get you guys back in the conversation. What are some of the structural changes that need to happen, and how can advocates play a role in helping those changes happen in Fannie and Freddie?
I'll jump in real quick. There's another GSE out there called the Federal Home Loan Bank System, and they are required to reinvest a portion of the profits back into affordable housing. Fannie and Freddie have no requirement to do that. And so that is one opportunity that is a structural change that could be made that could benefit the market. The other thing I would say is there was another question about what happens if the GSEs come out of conservatorship. Yeah. Mm-hmm. I think that would be that would only make home loans more expensive.
Yeah, and not to make this overly complex, but we also need some state level buy-in to some of these approaches. We're working right now on legislation that's about to pass in Maryland to create, for the first time in Maryland, a very clear path to allowing limited equity cooperatives to operate more freely in Maryland, remove some of the challenges that they're having. We're doing the same thing in Illinois on the community land trust and land banking side for specifically a couple of the Chicago area suburban counties. Seeing that kind of state and local driven effort being devoted towards that, I think could be helpful, Mac, maybe in kind of changing some of this dialogue with the regulator and with the GSEs themselves. They keep asking us to be the ones to figure out how to justify this long, expansive pipeline that they want to see. So we need to be working at several policy layers to make sure that we have enough foundation to be able to guarantee to them and start to solve that question of what's the pipeline for this opportunity if we were to develop it.
Great. There's a question here about, and this may be music to your ears, Tony, in part, but it says Fannie and Freddie should back limited equity housing co-ops and social housing models, which could allow for mass transformation. What could they actually, what are some steps that could be taken that would actually make, create, community land trusts, resident owned cooperatives, limited equity housing cooperatives easier to build in this country?
Well, it's what I said earlier. Again, they need to make a commitment to putting the same level of financial support that they put behind the private equity actors behind these kinds of approaches. Somebody needs to, maybe we need to advocate around that question and say, why won't you do the same level of support? And it's not just based on the private equity folks putting their own skin in the game. Again, if you're only going to serve that portion of the market, then let's abandon this idea that we have this mission and we're trying to support underserved markets at the same time as we're doing these other things. Again, the limited, and Sarah, you called it the couch cushions. I want more than the couch cushions. I want the couch.
I'm curious, Tony, if you could expand on this. Like, I don't think people necessarily understand how Fannie and Freddie are backing private equity, and what is private equity getting from Fannie and Freddie? What would that, when you say it should be similar for limited equity housing co-ops and CLTs, that makes sense. But what are the benefits that are not being shared?
One word, Steve, capital.
Yeah.
We've been talking about liquidity and tossing these terms around. It's the same thing that everybody understands. You need capital in order to run a business, and what we're talking about, they're businesses. Whether they're for profit or nonprofit, it's a business.
So, Steve, if we really wanted to take shared equity to scale, limited equity co-ops, CLTs, resident-owned communities, we need to have available capital for those entities to do portfolio acquisitions in the same way private equity does, right? And so, like, one of the things that we've been working on at the Lincoln Institute recently is this campaign around public lands. We're calling it, I think we're going to start, we changed the name, Community Land for Community Benefit. And the idea is we've identified hundreds and hundreds of thousands of acres of publicly owned land in cities available to build new affordable housing on. And this is just, we've screened out everything that you wouldn't want to build housing on, like a public park or right of way or a wetland. And there's still hundreds and hundreds of thousands of acres of land owned by mostly local governments. Now, let's say the local government would be willing to partner up with a community land trust and say, all right, we're going to dedicate this land to you at a really reasonable 99-year lease. And all you need to do is find the capital to build a whole bunch of housing on it that is going to be that's going to accommodate a whole bunch of people who are going to live in shared equity. What would the CLT need? They need working capital to build those houses and then sell them into the market. Who's going to give them that kind of capital, right? Well, deep-pocketed people like Fannie Mae and Freddie Mac, who might also be providing private equity, the acquisition capital to buy up all the single-family homes in the market. And by the way, there's nothing that's preventing a CLT from also participating in that market too. They could be buying existing single-family homes that are naturally affordable and adding them to community land trusts. And what do they need? Capital, right? Capital that's nicely priced with the right kind of terms, right? And these are the things that, if we had a vision for, let's say we wanted to create, I don't know, we want to have 20 million units of shared equity housing in the United States instead of the whatever, maybe a million we have now, right? We're going to need an infusion of a lot of working capital and a lot of worker bees out there, finding the land, building the housing, preserving the existing affordable housing stock. We need thousands of Champlain housing trusts who are going to be out there with 2,200 units of housing per that are going to be out there, protecting the affordable housing for the workforce. But they need capital, and they need the right kind of capital priced right.
Yeah, Mac, and Champlain is often pointed to because it's the largest community land trust, but also it's becoming less unique, thank goodness. Another example of what you're talking about is in Austin, Texas. There's a community called Mueller. It's a master planned community. It was a former airport, 800 acres. It's substantially complete on the ground. City of Austin and the private developer who created it agreed early on that they were going to incorporate shared equity housing into the master plan development. So it's there. It exists at a large scale. We're planning, hopefully, to maybe have an event in the future that gets more people down there and gets more eyes on it to say it can be done at this large scale. We don't have to wonder or point to only one example and claim that that's the unique aspect to be replicated. It's already happening. And they've been pushing us to be more collaborative with the private sector. I would say again, this Austin, Texas example, we have a private for-profit entity who saw the benefit of incorporating affordability as the trade-off to access the municipal land that you're talking about that exists throughout the country. So how come we can't sort of build that into this conversation?
And another missing piece, we need a CDFI like Fahi to be able to provide CLT mortgages, originate CLT mortgages, which exist, right? That could be bought by Fannie and Freddie.
I want to go to Austin and see the project you're talking about, Tony.
Hey,
Great.
let me know. They'll be happy to host you.
So I want to shoehorn audience question with the question. The last question I was going to give you guys was, how can housing advocates and leaders hold the feet of Freddie and Fannie to the fire, and what can policymakers do? And then there's actually a really good question from one of the participants here. Can one of the panelists suggest a good source for talking points for advocating for the structural changes needed at Fannie and Freddie? So, what are some usable things that folks on this call can take to, help push the ball forward?
I have one answer for both of those questions, Steve. Get involved with the Underserved Mortgage Markets Collaborative. It's the collaborative coalition. I can never remember. But this is the first time that the affordable housing community is trying to speak with one voice about the mortgage markets, and in particular about the role that Fannie and Freddie could play. And the more people that get behind that, where we have an agenda, a finite set of goals we're trying to achieve, and unified groups with real juice behind them, right? I think that's the most hopeful thing I have seen in the last few years in terms of trying to move the needle around affordable housing in the United States.
That's what I was going to say.
Yeah, we're with you on that.
And anything else you want to say, like in terms of specific arguments, like talking points? How would you? So that's the who.
Mm-hmm.
You can find those talking points at the Underserved Mortgage Markets.
Right.
The link in the chat.
All right. I thought maybe you could articulate a couple of them here, but no worries. Any closing thoughts that you guys have? There was this, I hesitate to ask this question, Tony, but there was a question about HUD 213. So if you want to tell me what that is, or tell the people, but can a philanthropic entity bridge the gap for meeting those requirements to build limited equity housing co-ops?
Let me say this instead. I think we need to continue having this conversation, and we need to zero in on, just as Matt pointed out with the coalition, what are the 3 to 5 things that we want to try to accomplish within a specific period of time. There's a universe of things to talk about in relation to all of this, but our bandwidth and their receptiveness is going to be somewhat limited. So we need to figure out what can we accomplish, and how do we focus around that. So even if you look at all those talking points, there's not just an argument that's going to carry the day. It's going to have to be a sustained effort and some unity to carry the message over a period of time.
Yeah, absolutely. Sarah, anything you want to add?
No, I agree with everything Tony said.
Okay. Well, we're kind of at the hour, so I want to try to be respectful of time. I'm going to put in our next webinar, which is coming up on May 14th. That'll be on what does a solidarity economy approach to housing look like, and you can see the panelists there: Kalia Kuno, Allison Chappelle, and Emily Quano. And I want to thank Mac and the Lincoln Institute of Land Policy for putting together this webinar idea, and Sarah Morgan from Fahi and Tony Pickett from Ground Solutions Network for agreeing to join the conversation, for all of your contributions. Thanks to everyone on this call for your excellent comments and questions. And let's keep the conversation going. I feel like there was some progress we made on this call, and I'm sure through these conversations we can start to move the field. So thanks so much.
Thank you.
Thanks, everybody.